Hello, everyone. This is Dino, and this is my first recording. We are going to record all the chapters for you in the RIBO binder. So let me get started here. I'm just setting up my Zoom. I just want to make sure that everything is good. So my microphone is on, and I'm recording the lecture. And I can see the recording is going on, as well as the proper microphone has been selected. Okay, good. Just making sure. All right. So I'm on chapter 1 and page 1. Okay. So there's really nothing really much on this page. They're just talking about the history, how insurance was started. And the one thing that I would drive attention to is the first sentence. Insurance is all about risk sharing. Okay. So what do we mean by risk sharing? Let me give you a quick example, okay? When I do the lectures, I'll be giving you a lot of examples, so I would suggest that you write them down in your binder or maybe in a notebook or something, so it'll really come handy when you're trying to find the answer to a question, and the example, they come to mind very quickly, okay? Just my suggestion. So let's say a customer's home is destroyed, and the home is obviously insured. So they make a claim. So even if the home is $1 million worth, the insurance company has to get there, and then they have to start, rebuilding the house. So that they spend $1 million, and the customer, they're just paying the regular premium, okay, $100 a month, $200 a month, whatever it is. But the promise the insurance company has made to the customer, or the insured, as we call them, is that if and when a loss happens, insurance company will come there, and then they will fix everything, and they're not going to ask them for any money. So remember, let's say this is a brand new customer. They've just paid $100. They just set up a policy last month, and now their house is burned down completely, okay? And that could happen. So my point is, who is paying that $1 million? Do you think the insurance company is paying that from their pocket? No. What happens is everybody else who live in that area, they share the loss of this particular homeowner. Also, this particular homeowner's premium will be used for other losses. So this is how the concept of risk sharing came about. Now, with that in mind, if you just read the examples of how the Chinese boat operators found it necessary to redistribute their cargoes to several boats. You see how they are sharing? Okay, that's the motif here, okay? And if one boat was lost, all the boat owners shared the loss, and no one was wiped out. Obviously, the homeowner doesn't have $1 million to rebuild their house, and the insurance company, they're not going to take it from their bank and spend $1 million. So they shared the loss among other customers in that area. And this is why, even if a customer didn't make a claim for many years, in some cases, their premium goes up. And they may wonder, why? I haven't made any claim. Then why you guys keep increasing my premium? It's a very legitimate question. But this is what's happening. That customer is paying for others' losses, which the insurance company has paid out. I hope that makes sense. So I'm not going to read this, the fire in London or whatever. Okay, so you can read them. I'm on page 2 of chapter 1, a very important 5 functions of insurance. So I want to say a few words about each of them, okay? It's very important that you understand them. So we already talked about the spread of risk, okay? The losses of a few people who have claims are shared among the many. So I already explained that to you just a couple of minutes ago, okay? And so what happens is a large pot into which all insureds pay their premium. So what do we mean by that large pot? So insurance is like a large pot. So all of us, we keep sending the premium to the insurance company. We keep paying the premium. So the insurance company, the manager of the pot, So all the premium is just kind of thrown into that pot. Okay, everybody's thrown into the pot. They're throwing the premium into the pot, and the insurance company, they manage the pot. So when someone has a claim, like somebody has a car accident, a home, a tree fell on a home, or whatever it is, the insurance company takes the money from the pot and then they give it to that customer, or they go and repair the loss. Okay, so this is how it works. So what happens is, remember, everybody's contributing into the pot. That means everybody is sharing the losses of the few, and they say, okay, take our money, give it to that person who is experiencing a loss now. Tomorrow, I may have a claim, so I'll be getting the money also from the pot. So this is the only way insurance can work, because nobody's just walking around with like a $100,000, $200,000 of money in their pocket, okay, to fix all their losses. So insurance, it was designed to help few people who have the loss by sharing others' premium also. Okay, kind of spreading the risk. Okay, now the next one is basis of credit system. This is a very important one. Let's say you want to buy a car and you don't have enough money, so you have a couple of $1,000s to make a down payment for the car, and then you're looking at a $30,000 worth of car. So you go to a financing company and then you are asking for a loan. One of the things the financing company will ask you is, okay, give me the insurance confirmation. Okay, so insurance companies, when they add a car for a customer, so they have to send a confirmation to the financing company if the car is financed. Now, why do they need that? So let's say the car is total. Okay, it went through a total loss. And so customer still owes the financing company another $20,000. Insurance company will pay that when they settle it with the customer. So when a car is financed, insurance company is going to make two checks when the car is kind of total loss, okay, total. One to the financing company where the money is still owed by the customer, and only the rest will go to the customer. So what happens with that insurance backing this whole thing, it becomes easy for the financing company to give them the money, to give the customer the money, because they know they don't have to depend on the customer. If and when something happened to the vehicle, the insurance company will pay them. So it just facilitates the credit, okay? Consumers' access to insurance frees up the credit, okay? That's what it means. So the availability of insurance to protect the investment to lenders helps to facilitate the granting of credit. So they are more than willing to give the money to the client, and they go and buy the car, and we insure them, right? So everybody is happy. So the third one is that eliminates worry and encourages entrepreneurship. So let me give you a quick example. Let's say you're planning to start a business, okay? Of course, there are so many uncertainties in the business, okay? I'm not talking about the profit or loss. What about you have a fire, theft, break-ins, lightning, windstorm, all of those things, okay? And of course, if your business is shut down, you can also get coverage for business interruption. Okay, let's say you had a big fire, it's going to take 3 months to fix the problem, then you can buy business interruption coverage for that. Okay, so during the time you're shut down, this coverage will pay you. Okay, and also when your building is affected by storm, windstorm, or water damage, fire, whatever it is, okay, then the insurance company is going to pay you. So you see, all the uncertainties of the future can be mitigated by getting insurance. So it eliminates the worry that you have in your mind. Okay, even when you buy a house and you're worried, what if something happened to the house? What if there's a water damage or something? What do? You transfer those worries to the insurance company, and in return, you pay them premium. Okay, it definitely eliminates worry. And for entrepreneurship, so people are more willing to go and start their business because they know, and buy insurance, of course, if something happened, the insurance company will pay them. Okay, so the future worries are just eliminated. And also the insurance company, as additional services, they provide a lot of other services, ad hoc services, as I call them, ad hoc services, like loss prevention, loss reduction. Okay, they have town halls, road safety, fire prevention. They have a lot of educational programs, anti-theft measures, okay, and nationwide campaign to fight insurance fraud. Yeah, they spend a lot of money, insurance companies, to prevent losses and also to reduce the losses, okay? Because some losses you cannot avoid, like a fire. You know, it may start fire. You have no control over, you know, everything, okay? You can try to prevent the loss, but you can only do so much. But some losses will happen, but how we can reduce them. I'll give you a quick example. So a fire may happen. Okay, you don't have, you know, we're not God. Okay, so we can't avoid everything. But when a fire does happen, how about if you have sprinkler systems? You can reduce the loss. So that's called loss reduction. Okay. Now I'm on page 3 here. The next item is a very important one for us because source of employment and in investment capital, there's no question about it. And I know this book was written in January 2011. And so at that time, they say 100,000 people, and I'm sure it's probably 200, 300,000 people working in the insurance industry, okay? So it is a great place to find jobs. The insurance industry, one of the biggest employers in Canada, okay? And also investment capital. So, and also look at this. It's very interesting in the box. They mention about not only like brokers and, you know, adjusters working the company, but there are lots of thousands of people working wide range of trades and professions such as car repair, construction, medicine, law, and accounting. All of those is related to insurance. Okay, so you can see how many different sectors the people get jobs. And so insurance is big business, no question about that. Some of these companies like Aviva, Intact, you know, they are multi-billion-dollar companies, okay? And claims total into the billions of dollars annually. And also assets controlled by insurers amounted to more than 88 billion in 2003. Now we are in 2021, okay? So it could be a lot more. All right, so with that, we're going to define the insurance, okay? The definition. So there's a long-winded definition on page 3, but then they break it down nicely, like 1, 2, 3, 4. Okay, let's go through that. So insurance provides a means of shifting one's financial responsibility for a loss to another party. That's very straightforward. We already saw that. So when you buy a home or when you start a business, you're so worried that something may happen, and you'll be financially responsible for that. And you know, you are just reluctant to start a business because you don't have enough money if something happened. Okay, what do? You shift that responsibility for a loss to another party, which is the insurance company. Okay, so you are the customer who starting a business or buying a home, and you're shifting the responsibility to another party. In return, of course, you're paying them premium. Okay, so on page 4, these examples are very nice examples. Okay, I just wanted to really spend some time to know this example. So they make the point so clearly. Okay, so Butler and Betty Butler, Bert and Betty Butler own Butler's Best Buy Furniture Limited, a home, carriage, boat, and 5 vehicles. Okay, so their savings would not replace any of these items in the event of any accidental loss. They don't have that much money to replace them, nor replace any of these items in the event of an accidental loss, nor cover the cost of a significant legal judgment against them. That's another huge thing insurance company will cover, that when your customer gets sued for something they did through their negligence, and they caused either bodily injury or property damage to others, and the other people, they want to take your customer to court. Okay, do they have the money for the lawyers and to go fight in the court? What if a verdict comes and they have to pay $500,000 to the other party? Insurance company will pay them. Okay, so you can see a huge financial responsibility from your customers being shifted to the insurance company. In return, they just pay the premium. Okay, now the second one, payment will be made only in the event of the happening of a certain risk of peril. So I'm going to pause the recording. Okay, I've got a call here. Okay, I just paused the recording just to take an urgent call here. So So we are on item number 2, the definition of insurance. A payment will be made only in the event of the happening of a certain risk or peril. So basically what it means is there's so much fraud also going on, okay, in the insurance industry. People are making claims and, every year they have a study. The fraud is just going into like a few $1 billion of fraud going on today, okay? And so insurance company, they are there to help the people, and only when they have a loss. So something has to happen, okay? And they have to prove that something like water damage, fire, all of that, something they have to prove. And event of the happening of a certain risk or peril, okay? A peril is something that will cause a loss, like fire, water damage, a windstorm, lightning, explosion. All those things are called perils, okay? So something has to happen for us to get paid out. So why do they say this? Because a lot of people are making claims which are not, they are fraudulent claims, okay? And so it says here the insurance meaning given to risk. The insurance meaning given to risk is the chance of financial loss to which the object of insurance may be exposed. So what the object of insurance, we are talking about a car, a home, or a business. That is the object of insurance, okay? And also, insurance can be purchased to cover a variety of exposures or chances of financial loss, okay? So we already said that. That's why we go and buy insurance, because we don't know what's going to happen to our home, to our car, or to our business. So there's a lot of uncertainties, a lot of chances we are taking. So that's why we go and buy insurance, okay? But we have to prove that something happened to get the claim paid out. So in the insurance industry, they also use the word risk as a noun, meaning you can use the word risk as a verb. For example, oh, I'm not going to take that risk. It's very risky. That business is very risky. That trip we are about to make is very risky. But then we can also use the word risk as a noun. That means an insurance company will say, oh, that I'm not going to take that, I'm not going to insure that risk. That means they're referring to a car or a home or a business. Okay, so they refer that in a noun. So here it says, risk means the risk has also come to mean the object of insurance. So what the object of insurance? What is being insured? A car or a home or a business. So we can also call that as a risk, okay? So a peril simply defined as the cause of loss, such as fire, wind, hail, which I already mentioned. And then the third definition, the amount of the payment is restricted to the amount required to indemnify the insured. So what the meaning of the word indemnify means, to reimburse, to write a check, to put the customer back to the same position before the loss. That is called to indemnify, to make them right, okay, meaning that give them the money for the loss, okay, to reimburse them. That's all it means, okay? So it says here the amount is restricted to the amount required to indemnify, okay? What that means is don't make fraudulent claims, okay? When you make a claim, if something was stolen, okay, don't tell me that you lost 5 iPhones and 6 iMacs. We have received such claims, okay, and they just live in a condo, like 3 people, how they're using 5 iMacs, and they had $100,000 worth of jewelry is lost. Come on, okay. So when they investigated it, they couldn't prove anything. And there's only 3 rooms, and where did they keep 5 iMacs? This happened in Mississauga. We had a claim, and we gave it to the special investigation unit, and they said, no, we're going to deny this claim. This is a fraudulent claim. Okay, that's what they're saying here. The amount of the payment is restricted to the amount required to reimburse the insured, not more. Okay, there shouldn't be. That is called the principle of indemnity. Okay, the people receive the actual amount of the loss, no more or no less. Okay, all right. I know there's a lot of fraud going on. So I'm on page 5 here. And so you can read the example, the amount of indemnity determined by value, property immediately prior to the loss. Of course, when you make a claim, they have to determine the value of the thing before it was lost. Okay, so that's what they're talking about here. Now, the insurance covers losses to which the object of insurance may be exposed. What the object of insurance? It can be a car, home, or a business. So what is being insured? So the purpose of insurance is to pay for those losses which are both accidental and future. Okay, it shouldn't be something that you expected to happen. I'll give you an example. Let's say you don't maintain your car. You just keep driving your car, and then one day it broke down. No accident, nothing happened. Okay, it just broke down, and the engine just seized because you didn't change the oil, you didn't check certain things, and the engine just seized. And then you want to make a claim. No, insurance company will not pay that claim. Why? Because this is something you should have expected, because you know that you're not maintaining the car, you're not fine-tuning, you're not maintaining, you simply drive every single day, drive, and then one day it just quit on you. What insurance company will cover is anything that happens suddenly and accidentally, and not something that happened before. It has to happen in the future. Okay, not already occurred. Okay, no. It has to something that is you never expected, but it happened suddenly and accidentally, like a fire started. Okay, a lightning struck the building. A windstorm passed through your area. The roof is gone. Yeah, this will be paid by the insurance company because it happened suddenly and accidentally. Okay, not that something that you expected because you didn't maintain. Okay, so deliberate losses and losses which have already occurred are not insured. What deliberate losses? Let's say one of our customers, he had a fight with his spouse, and then what he did, he took a hammer, and then he just destroyed about 3-4 walls inside his house. He just went crazy, okay? And then what happened was he made a claim for that. And so the contractor went there, I just sent the contractor out, and they asked him, so how did it happen? And he was just reluctant to explain how did it happen. And then finally the wife had to tell the adjuster, the contractor, that, well, he lost his mind, and this is what happened. He just destroyed the thing, and we denied the claim. Yeah, of course. Okay, you just pay out of your own pocket because the deliberate losses and losses which have already occurred are not insured. Okay, and society does not support paying for them. Okay, sometimes people will attempt to purchase insurance after a loss has already occurred. So let's say a homeowner didn't have insurance. Okay, and then they had a loss, and now they're trying to purchase insurance to make a claim. Okay, so that's why when somebody comes and asks for insurance, the sales broker will always ask, did you have any kind of loss? Okay, one of the major questions we'll ask you, did you have any losses? And so we have to be very careful, because why they didn't have insurance before and why they're getting the insurance now, right? Okay. Now, the indemnity provided, that means, what the reimbursement they do for the customers can be in the form of a sum of money and other things of value. So sometimes the customer, let's say you had a water damage in your basement, and a contractor, your uncle is the best contractor in town or whatever it is. So you can negotiate with the adjuster to get a cash payout. Okay, because usually the insurance company, they prefer to repair it with their own people. Because how many customers, they take the money and then they go for a vacation. Yeah, many customers have done that. Okay, so that's what usually the adjusters will say, look, we prefer to do that. But in some cases, they will agree to provide the cash money, but at the same time, they will ask for proof of repair. Okay, so don't take the money and just go on vacation. Okay, you have to do the job and then send a proof of repair. So but the insurance company, they reserve the right. The insurance company always has the right to settle a claim on the basis of repair or replacement, as opposed to the payment of money. If something is destroyed, the insurance company always has the right either to repair, rebuild, or to replace. You cannot just insist, oh no, I want new. I want a new stuff, okay? No, insurance company, they will not listen to you because there's a condition. If they can repair something, they will repair it, okay? And you cannot also insist to get money, like cash payout. You can negotiate with the adjuster. In some cases, yes, they will agree, okay? But you cannot say, no, I want cash. I want you to pay me cash. No, you can't do that. So here, the insurer may opt to repair versus cash settlement. So the Butler's insurance contract is with the Fortress Insurance Company. So they had a roof of their dwelling was severely damaged during a windstorm. And so generally, when payment is required for both labor and material, the insurer would agree to pay to repair or replace the damage rather than make settlement in the form of money. You know why? Because insurance companies, they give a lot of business to many companies, construction companies. And so they get warranty if something goes wrong, because these companies, they get millions of dollars worth of business from the insurance company and they do a good job. Okay, otherwise they lose the business. Big business from an insurance company. So they give warranty and they're very careful to use the right material so customers don't complain. Okay, so that's why the insurance company, they prefer to give it to their own, they call preferred providers for the insurance company, and they do a good job usually. Okay, so I'm on page 6, property and casualty insurance in Canada. This is the industry that we work in. It's also known as the PNC, and it's also known as general insurance. Okay, property and casualty, PNC, are general insurance. So they use these terms interchangeably. So they involve many types of insurance. Okay, they just don't include life and health insurance. Okay, anything other than life and health. So, for example, automobile. Okay, this is the largest single class of property and casualty insurance in Canada, as well as in the US, automobile. Why? Everybody's driving a car. Okay, so this is the largest class. So, property insurance, liability, we already mentioned that. So, what is this liability insurance? If you cause property damage or bodily injury to others, and it's so bad, that person to whom you caused the bodily injury or property damage, they sue you. Okay, then you become legally liable for that, and you could be, in big trouble with the law when you cause, especially bodily injury, like either using your car or maybe in the winter time you didn't shovel the snow that you're supposed to, you didn't salt the place, and some school kids, they passed by in front of your house, they fell, they're hurt, they will sue you big time. Okay, we are coming up to winter season here. You better remember that. Okay, there are a lot of lawsuits that we have seen. People slipping and falling, and they can sue you, and the law allows that. So that means now you're legally liable. So your policy, it has the coverage included. Usually it's $1 million. Okay, so if you look at a property policy or a condo policy or a tenant's policy, it has 2 sections. Section 1, the Roman one, is all about property. What property they cover, your home, your contents, and everything. The section 2 is liability. Okay, all right. So then on page 7, they say how the insurance companies are organized, and they talk about private insurers and government insurers. There are 2 big sections here: private insurers and government insurers. Okay, so under the private insurers, there are 2 types. One is a stock company, and the other one is a mutual company. It's very easy to understand. I can tell you right now, there are no more mutual companies in Canada. Okay, I'll get to that in a moment. So what is a stock company? Most insurance written in Canada today is provided by stock companies. So these are like Aviva, Intact, TD Insurance. Okay, 99.9% of the companies, they are known as stock companies. So what that means is they sell their stock, okay, like shares to the public. Okay, so you can see pretty much you can get any company and you can say, oh, okay, this is a stock company because they're selling their share at the New York Stock Exchange, at Toronto Stock Exchange. So they're all on the stock exchange selling their shares. Okay, they are called a stock company. Now, a couple of things you want to remember for the exam is, so they use the private funds or through public sale of stock. Okay, they sell the shares. So the ownership rests on the hands of the company's shareholders. So the company is owned by the shareholders, and you can sell your share at any time you want, okay? And the main purpose is to make a profit from the investment. That's all you need to know about stock companies. Okay, they are privately funded or through selling the public shares, the sale of stock, and the shareholders, they own the company. And the main purpose of stock company is to make a profit. Okay, now the mutual company, the word mutual means helping each other mutually. You do something good for me, and then then I return. They're also known as reciprocals. In some book they say reciprocals, but here it's just they're mutual, like for the mutual benefit of each other. Okay, so you can see they are owned not by shareholders, they are owned by policyholders themselves. They own the mutual company, and also making the profit is not their primary motive. No, it's not. So they want to make sure the losses for their policyholders, whom actually own the company, it's less. Okay, so they try to do some risk management and everything. The main goal is to provide policyholders with insurance at as low cost as possible. How you can keep the cost as low as possible? By not having any losses. Okay, so they do a lot of risk management, training, and so on and so forth within their policyholders. So they own the company, and so they want to keep the losses less so that the expense is less, the cost of insurance is less. Okay, so they're not into making profit. And stock and mutual companies are generally able to meet the standard insurance needs of most Canadians. So we have enough companies. Coast to coast, we have close to 250 companies. Okay, most of them are stock companies. That is the private insurance companies in Canada. What about the government? Immediately you can think of employment insurance, EI, right? If you, God forbid, if you lose your job, then you apply for EI. You have a medical insurance, like in Ontario, we have OHIP, okay? Workers' compensation. So you can have a lot of examples here. The federal and provincial governments are involved in providing various insurance plans, including medical insurance, employment insurance, workers' compensation. And then governments in 3 provinces and also in Quebec, they provide even the basic automobile insurance, okay, which is British Columbia, Saskatchewan, and Manitoba, and Quebec provide compulsory automobile insurance coverage to residents, and may in most of these provinces compete directly with the private insurance. In those 4 provinces, the government has taken over to provide the basic compulsory automobile insurance. Like in Ontario, all the insurance provided by private companies. Okay, but in these 3 or 4 provinces, the government provides, and in fact, they compete with the private companies. Okay, the next section, it talks about how insurance is distributed. What that means is how the insurance company, they sell insurance to the public. How do they sell them? So they use 3 channels, okay? One is called the direct writing system. It's very easy to understand. A direct writing means the company, a good example is TD Insurance, Belay Direct. They contact the clients directly, the public. They don't use any middle person, okay, like a brokerage, a broker agent. No, they don't use them. They advertise directly, and they get the customer. Usually they have a call center, so the customers have a toll-free number to call in, and they have. I worked for TD Insurance for 8 years. Okay, so they have hundreds of brokers in many call centers, right? So they contact the public directly, and the public call them to get the policies done. So they are direct writers, and so these brokers, it depends how the company is structured. Mostly they're on salary. They could also have a salary and commission. Okay, but the point is the insurance company contact the public directly. Okay, the independent brokerage system, this is the majority of the insurance company, they're using independent brokerage system. So we are working in a brokerage, okay, my insurance broker. So we get the clients for these insurance companies, Intact, Aviva, Economical, Travelers. They go through us to get the clients. Okay, so this is another way they sell their insurance is through us. Okay, so there are over 7,000 independent brokerage insurance offices in Canada, employing over 30,000 people. Again, this book was written in 2011. Okay, so it could be a lot more people now. And over 80% of all property and casualty insurance is sold through this system. Okay, so the companies like Intact, Aviva, they don't want to contact their clients directly. So they want to go through brokerage. So they pay us commission. Okay. So the brokerage owners are not employees of insurance, and most cases choose to represent more than one insurance company, like MIB. My insurance broker is a good example. So we deal with, I think, over 20 companies. Okay, we don't deal with just one company. Okay, we deal with many companies. So we get clients, and then we can choose which company we want to put the client with. Okay, and we get the commission from that company. And another important thing is in the direct writing system, like TD, all the clients belong to them because they got the clients directly. But let's say Intact, they're dealing with through us, and we have tens of thousands of clients with Intact. So all those clients, they belong to us, the brokerage. For example, we can remove 10,000 clients from Intact next year and move them to a different company. Intact cannot say anything because those clients, they don't belong to Intact. They came through us. So we own those clients. Okay, that's another point you have to remember. So the brokerage is getting a commission by the insurance company. Now the agency system is something different, but here, while brokerage and agency are often used interchangeably, there is a distinction here. Agents are distinct from brokers and direct writers because the agents usually they work for one company, okay, and they have their own offices. They're like small business owners, and there's agents are paid a commission and bonus for their business they sell, and agents have ownership in their book of business. The best example would be State Farm and cooperators. So they have what they call exclusive agents. So these people, they don't work for many companies, the agents, okay? And they work for only one company. And usually, some of the office expenses are borne by the company, and they get commission, and so they only work for one company. So these are the three way the insurance company they sell insurance, okay, to the public, right? Now, a quick word about the Lloyds of London. I'm just looking at how many pages we have. I may just stop at a certain page and then do another lecture so that the file is going to be not going to be so big, but I will mention very clearly on which page I start and which page I stop, okay? Now, the Lloyds of London is the very first insurance company that was created back in the UK a few centuries ago, okay, in the late 17th century. And it all started in a coffee shop. If you want, you can Google it. You can just say history of Lloyds of London. It's a pretty interesting story. How from a coffee shop now it's the largest insurance company in the world. Okay, and it says here not an insurance company. So why? Because it is so big, and they are all over the world in all companies. So it is. It's called. It's not an insurance company, and it does not transact in insurance business itself. You cannot just directly call them and get a policy done. Rather, the Lloyds Corporation consists of a group of companies and individuals called underwriters who assume the risk for themselves. Okay, so it's very unique situation with Lloyd because they are so big, they are all over the world. They're operating, so they cannot just deal with the public. So if they directly deal with the public, like TD Insurance or Intact, they'll be dealing with a few billion people. Imagine that. A few billion customers calling you for policies. So it's not going to work, okay? So what they did, they created syndicates, like groups of brokerages, thousands of brokers, they got together, they formed syndicates. So the syndicate is what? Like a group, like a big group, members, okay? And you have to actually go for a course with Lloyds to get their policies done, to work with them, because they have their own kind of protocols and everything. So remember the word syndicate, it should be somewhere, yeah, here, right here, syndicate. And then they call this as a slip. Okay, the Lloyd slip. It is just a listing of the risk they accepted. Okay, so there are several non-underwriting members who act as broker intermediaries for various large syndicates. So you can see the company is so big, they're dealing with all over the world. So there are lots of syndicates formed, and they have also other intermediaries they use to get to Lloyd's, okay? Because it's such a huge network. There's no like direct communication from the customer to the Lloyd's, that they go through groups and subgroups, and then, all of it. It's so complicated, right? And so here, to place a risk at Lloyd's, the producer must provide the broker with the necessary underwriting information, the details of which are presented by way of folded sheet or a paper or slip. So let's say you're looking for coverage from Lloyd's, okay? You're not going to pick up the phone and call them. No, that's not going to happen. So you will find out who is the Lloyd's broker. It's also as the intermediary. Intermediary is the middle person, okay? And then you're going to tell them, okay, I'm looking for coverage. Okay, this is the coverage I want. So you're going to write them down, and you're going to, they say in a folded paper. I don't know whether it's so funny. So you have to fold the paper and then give it to the broker. This is the coverage I'm looking for from Lloyd's. You don't have to say you're looking for from Lloyd's. So let's say this is a Lloyd's broker, then he's going to get Lloyd's, and then he's going to get you the coverage. So that's called a slip. Okay, remember that for the exam. There may be a question. So the underwriter commits to a certain percentage of the total limit of liability, and when 100% of the risk is subscribed, the slip is forwarded to the policy signing office. Okay, so the point here is that Lloyd's is not an insurance company. It is almost called an insurance market. I don't know if they mention it here. And they are formed by syndicates, like group of tens of thousands of brokers get together. Okay, imagine how many companies are there. That I heard when COVID hit, it affected 182 countries. Okay, and you can believe that Lloyd's is all over the place. In all the 182 countries, Lloyd's is operating. Okay, that's why they need to go through others to get to Lloyd's, called syndicates. And then the slip is, the coverage that you need, you write it down and you give it to the broker, and that's called a slip. So let's just do maybe one more page here. I'm on page 10 of chapter 1. So purchasing an insurance policy from a broker, this is obviously called new business. Okay, so this is a very simple information here, almost like customer service. So the client should be greeted, in a professional way, and then an application should be completed. All questions should be asked of the client. Let's say they want to insure a car. Okay, what the year, make, and model of the car, who will be driving it, how much you paid for the car, and then how will you use the car? Will you drive the car to work, or just for pleasure use, or do you have a business use? Okay, all of that. Okay, even do you have winter tires? Will you be using? All kinds of questions. Okay, and then the payment arrangement has been discussed, whether you want to pay monthly or in one shot. Okay, all of that. And then also the documentation may be a binder. We also give them a confirmation of coverage to the client. So if they get pulled over, then by the police, they have something to show that the vehicle is insured. And it's called a binder or a liability card. And so the brokerage, we can issue that, okay? And the brokerage issues the policy, a copy of the application and declaration page are sent to the insurer for its records. So in our brokerage, no, we don't issue the policy, but there are many brokerages. They've been allowed to issue the policy. If that's the case, then the brokerage will issue the policy to the client, and then they'll send copies of all the documents, the application, the binder they send to the client, everything to the insurance company, because the policy belongs to the insurance company. We are the middle person. We get commission, but everything is issued. Everything has to be recorded in the insurance company. Okay. So if the brokerage does not issue the policy, like in our case, we don't issue the policy, the application is sent to the, these are in the processing department, you have the uploaders like Daniel. What they do, they upload the to the insurance company. That's what the point number 5 is exactly what we do. In our brokerage, we don't set up policies, but we upload the application to the insurance company's portal. This is what they're talking about here. Okay. And of course, a year passes by. Usually the policy is valid for 12 months. Okay. And then we have to renew the policy. And what they say here, I'm on page 11, it is more expensive to put new business on the book than to renew it. That's why it's very important that we keep the customers happy. The customers who are already with us, we should not ignore them, or we have to treat them with respect, and especially when they make a claim, we should assist them, and just because we got the business and then we don't call them. So, and when they call us for some help and we are not very paying any attention because, we already got their policy, we're making money, and then they're going to move to a different company. So the point they're making here is to get a new client, you have to spend more time and money to look for a new client. And it's a very competitive environment right now. Many companies are competing to get new clients, but you already have the client. So make them happy and keep them happy. It's less expensive to keep the client that you already have. So the renewal process begins when the expiration lists are distributed. So the expiration list is when a specific policy expires. Obviously, it's 12 months from the date it was set up. So every brokerage, they will print a list from time to time, which policies are expiring. Okay, usually they print it like 2 months in advance. Okay, so they can work on them. So the renewal process begins when the expiration lists are distributed. That means they'll print the list and they'll give it to the brokers or underwriters, who is responsible to renew the policy. Well, most personal line automobile tenant homeowners policies are automatically renewed. That is true. All policies should be reviewed prior to the renewal date. And that may not be possible. We need so many people to review all the commercial, yes. Commercial, there's so much going on with the company. Maybe they changed something. Maybe they're selling a different product now, whatever it is, okay? We have to work on them, review them every year. But personal line policy, homeowners, car, it's automatically renewed for the most part, okay? So it is important that someone from the firm contact the insured prior to the issuance of the renewal policy. Again, it's not going to be possible for every single customer. Yes, commercial clients, yes, we do that. Most brokerages will do this as much as 2 to 3 months prior, okay, to expiration of the policy, all right? And so in many cases, coverage may need to be added or deleted and limit changed if the customer wanted that. So the policy that has to be endorsed, what the meaning of endorsing a policy? To make a change to the policy or cancel and rewritten for whatever reason. It's all possible. Okay, maybe the customer had 2 or 3 claims and he had a couple of tickets, conviction. So the company that he is with, they're going to refuse to renew it. So now as a brokerage, we're going to take them to a high risk market. Okay, we can find coverage, but he's going to be paying more. So now in this case, it involves canceling the policy and then rewriting the policy. Okay, so that's also a possibility. And many insurance companies also provide brokerage with the renewal listing. So the insurance companies may also, if this is they agree to the brokerage, okay, and they may be paying some fee to the brokerage. So they will send the renewals to the brokerage. They'll send the renewal list. Usually it'll happen about at least 2 months before the renewal. And then the brokerage will go through the renewals and see if there's anything the customer needs to be contacted. In fact, the insurance company will also send more information, what, if there's somebody to be contacted, they keep a track of that. And yeah, that's also possible. So most brokers have developed their own renewal listing. And so the brokerage might request that all homeowners clients complete a questionnaire prior to renewal. It depends, okay? So we can create a protocol. We tell all homeowners to complete a questionnaire before we can renew them to see if something changed. Maybe somebody put in a new swimming pool. Somebody has something else. They start a home-based business. So the questionnaire will capture those things. It's possible, okay? We can do that. Letters may be sent recommending increased third-party liability limit. Sometimes we'll also send like a broadcast letter to all our customers recommending some higher coverage. We can say that the lawsuits in Canada is increasing, and we suggest that you increase your liability of 1 million to 2 million. And some customers may call, they purchase that. Many they may not do, but we may send out that letter. So after the client contact is made and renewal decisions have been made, it's necessary to prepare a binder and invoice if the policy cannot be provided by the renewal date. So, okay, I'm at the bottom of page 11. After client contact is made and renewal decisions have been made, the renewal is requested from the insurer. So this is in the case of the brokerage is doing the renewals because the insurance company sent the renewal list. And then we have already contacted the clients and we reviewed the policy. And then now we are going to request the insurance company to issue the renewal. Okay, it'll go from the insurance company. It may be necessary to prepare a binder and an invoice if the policy cannot be provided by the renewal date. In some situation, there may be a delay by the insurance company in doing the paperwork. This happens all the time. So in that case, the brokerage can issue like a temporary binder to the insured as a confirmation of coverage. Okay, and also send them the invoice so they can pay the money while waiting for the insurance company to issue the original renewal policy. Okay, sometimes it may be after the renewal date. Okay, so what if a loss happens and they don't have the renewal? So that's why the brokerage can immediately issue, before the renewal happens, a binder. A binder, the word binder is used in the homeowners and commercial to signify it's a confirmation of insurance. That's all it is. Okay, that's all it is. And of course, when the renewal is received, it must be carefully checked against both the expiring policy and the renewal instruction, just to make sure that the coverage requested by the customer is that's what is on the policy, the renewal policy, and there are no mistakes. Okay, these mistakes are happening. We have seen many mistakes. Okay, so we have to, it's the brokerage's due diligence responsibility to make sure the coverage that is being given by the insurance company, it matches the coverage requested by the client. So established expiration procedures must be followed carefully to maintain control. So the renewal is, it's a very important process. So we want to make sure that we start the renewal at least 2 to 3 months before. Okay, that's the point they're making here. And you have to have a strict procedure, protocol in place that as many companies have a renewal department. They just work on renewals, okay, all year long. Because, policies, they start on different dates. Not all the policies from customers, they start on the same day. Okay, so the renewal is a continuous process, okay? And they follow a certain procedure, so they don't miss out anything, okay? So what I'm going to do here, I'm going to stop the recording. And in fact, I'm going to test it out. I'm going to upload it and listen to it and see if everything's okay. So I just completed page 11 of chapter 1. And in fact, when I save the file, I'm going to actually label my recorded lecture as chapter 1. And, this will be from pages 1 to 11. Okay. So if you're listening to it, then you know what pages you're going to go through. Okay. So I will see you in my next lecture. Okay. Thank you.